Yes. Good afternoon. It is Thursday, August 27th, 3:25 p.m. I am here with David Titus. David and I have done one of these podcasts, and when we were setting this one up, I called David and I said, I was looking through all 41 of the podcasts I've done, and the one that David and I did, I thought it was the second highest viewed, but I had to go all the way back. It was the fourth highest. So listeners and folks in our group must have liked it. And we wanted to do another one of these just to address some big picture issues. Since David and I have talked, we've got a big picture room on the Contrarian. David has gone through some health issues and he was worried about contributing to that. And I said, "No, don't worry about it." I said, Anu Allen, in the crypto room only contributes, when he sees fit or something's going on. And I just saw he posted something where he's in Alaska today. So congrats to Anu Allen, and we love hearing from him. And so we want to wish David through his health journey here, but I'm excited to have him here today. And I wanted to talk about the energy market in particular. There was a conversation started with natural gas, but before we get into that, I just want to say hi, David, and if you've got anything to say before we jump in.
Well, hello, Travis. Hello, everyone. I don't have anything in particular, but I know we're going to touch on natural gas or dive into natural gas and probably the oil market, and that sounds very appropriate to me.
Yeah, and David's got some background. He's really been on top of um, the developments in the oil market. So I'm excited to talk to him today. So with that, um, in Donald's room, there was a conversation about, and Donald posted something about the European gas storage was less now than it was in 21, 22. But prices, they're higher, but they're not reflecting, maybe the fear that we saw when we were in the Ukraine, Russia, that first kind of phase of the war there. And as TurboCat, Aaron and I were walking through it in some of the conversation, it's interesting because the Dutch TTF natural gas futures are, I looked at today, when we were talking about it, they were 66 euros. That's approximately $80 um, in gas prices per megawatt hour, but that doesn't translate to the Henry Hub price because the Henry Hub price is based on the 1 million British thermal unit. So to give you kind of perspective there, in 2021 at the high, the European price was 182 to 187 euros. The exchange rate was 1.13, so it was 205 to $210 per megawatt hour. But that was in translating it to the Henry Hub equivalent, it was $60, back in 2021. So we're, maybe $20 today, roughly, and given where storage is, people have thought that maybe that would be higher, maybe 40 or 45. But the prevailing notion is that buyers don't want to commit because if there really is a resolution to the Iran-US war, they want to be on a hook buying gas higher here. But and I think Dave would say it's similar for oil. As we delve or get closer to the end of the year, closer to winter, the inventory situation just it becomes more pronounced and there's a risk for a spike in natural gas. And so that was the 2021 price. 2022 was the highs in natural gas prices, and the euro was closer to parity. So per megawatt, it was 330, 345, so almost the same in dollars. But the high in natural gas was 100 to 105. And in my, kind of just walking through it, one of the ironies I thought was, and I wanted to get David's take on this, was everybody's focused on oil, and there could be an, a moment in oil where there's a realization where inventories are at. But because the natural gas, some oil is getting through, we don't know how much, right? That's one of the key questions with oil. But natural gas, the Qatar facility is running 20% less of capacity. So the first real flashpoint may be natural gas. So I want to see what David thought about that.
Yeah, I mean, first of all, it's plausible. Um, with Qatar facility damaged and shipping a problem throughout the Mideast, Hormuz, the Red Sea. I mean, constraints are everywhere. Um, Getting gas to Europe uh, is much harder now than it would have been before the war. There's less of it, and transporting it is much more challenging. um, to me, and Europe, from what I understand, you know, is operating with their storage at extreme lows. I don't know historically how low, but I believe it's really quite serious how low it is
for natural gas.
for natural gas.
Yeah, yeah, it's actually worse than 21 or 22 for comparison. So
It's right. So it's very severe, and it's in contrast to the U.S., where we basically have a surplus to the 5-year average. I think we're at about 200 BCFs in storage, and so that's 200 BCF above the 5-year average, essentially. So we have an abundance, and Europe has a severe shortage. However, so that's Europe's situation. Europe, I could easily see, um, triggering something analogous to a run on natural gas because of their shortage and a desperation to have heat during winter, and Europe, Northern Europe particularly, can be extremely cold. So, but but that's Europe. In the U.S., um, we have two factors that are operating that, to me, are, I mean, as I see it, and as I interact with the AIs, especially on Google, inquiring about natural gas and where the market is heading, and I do that from time to time. These two factors are front and center, and they're what everybody already knows. It's the massive build out of LNG capacity here in the U.S. I mean, it's enormous. And
and I'm just going to interject for a couple quick things there. One, we're about 170 BCF above the 5-year average in the US right now, but we're actually in August where we've cut into that, or we're cutting into it. And then
because
two,
we've had some hot weather.
and yeah, and production has been relatively constrained.
It's been benign. Yeah, that's true. And I sort of wonder about that too, actually. But
Yeah, and we'll come to that because I want to. You could argue with oil prices where they are, the Permian's incentive to run all out here, right? And so this might be peak production, but we'll come back to that. And the second thing on your point about the extreme power generation needed for the data centers, I saw Elon Musk the other day said we are rapidly getting to the point where it's not the amount of computer chips that we have, the graphics chips, the GPUs, CPUs. He said it's just power is
the
the constraint.
constraint is electricity.
Right. And he said what's happening, and he said you're going to get there by the end of this year, so 2026, and we're already in August, about to turn to September. And you he said you're going to have these sites that have the GPUs and the CPUs there, but they can't be turned on because they don't have the power, So
Right.
that's
So I mean, I mentioned there's the two main factors operating here in the U.S. more broadly than the U.S., but I mean, I see it most clearly here, and it's this build out of the LNG capacity, and it's the build out, pardon me, of the AI data centers. But the AI data centers are materially less in BTU than the LNG capacity. People might focus on the data centers because it's such a hot topic in the markets, but for calculating demand for natural gas, the LNGs, I don't know that, I can't recall the exact number, but the build out, between 25 and 30 is, I don't know, 25 or something like that, BCF a day, and the data center is maybe a fourth or a fifth of that. It's in the 5, 6 BCF a day neighborhood from the figures that I've come across and that are sticking in my head. So 25 versus 5 versus 6. I mean, rough speaking, that's maybe about the relationship. But think about it in some, you know, 30, 31 BCF a day extra in a very short period of time by 28ish, 29ish. So the thing is, the starting proposition here, it's natural gas could come first. Well, natural gas is not going to wait. Natural gas is not going to spike in price after we reach 28, and then there's in the neighborhood of 20, 25 more BCF in demand per day. No, it's going to ramp. It's going to anticipate. Theoretically, the market is forward looking. Theoretically, maybe it's 6 months forward looking. You know, it's anticipatory. Of course it's reactive, but it tries to be anticipatory. It tries to build in all the latest information, and this information is becoming. There was a time 2 years ago or so. This is hard. This type of information was not easy to get, and I was reliant on Antero's reports from time to time about the LNG build out to get some estimate, some forecast of what the BCFs in the future might be, for these LNG facilities. That was pretty much my go-to source. But now it's really very widely available, and you can just ask the AIs about it, and you get an answer right away. So if I can do it, and I'm not a pro, I'm an amateur investor. The pros, of course, have a real edge. They can get it better, faster, more completely, and so on. So they're probably already seeing this. Musk's quote you just gave, Travis, that he knows and he knows the big constraint is not compute, it's power.
Yeah, and I'll interject with three things there just to tie in with Musk. I also saw today, I've owned a company because when I worked at Oxford, we worked with the founding family that did the IPO for First Solar, and they're the largest solar manufacturer in the US. And they produce, by the end of 2027, it's going to be about 18 gigawatts of energy from solar annually. Musk today announced with Tesla that they're going to build one facility to produce everything vertically integrated, so not importing anything from China, but all the parts vertically integrated in Texas. And they're going to aim for 100 gigawatts of capacity, right? So he's
And that's like a
seeing,
5x increase,
yeah, from the biggest
five
solar,
and a half X.
yeah, 5, 6 times
Yeah.
from the biggest solar producer in the US. So he's seeing that what we're talking about, the power bottleneck. He's trying to solve it to create his own power generation, right? So he doesn't have to rely on the backlog and the turbine blades or something else. So that was one thing. Um, I forget what my other 2 points were, but they'll come back. So
Well,
uh,
but he's going the vertical route, but of course, simultaneously in parallel, everyone is also trying to do a conventional build out to the max. And so
right.
they'll get as many gas turbines as they can. And the
Yeah.
demand for that gas is definitely going to go up,
Well, and you see like
less than for LNG.
well, yeah, and you see I remember my other 2 points, but before I even get to those, you see that turbine manufacturers like GE Vernova and Siemens, they're sold out to 2030, right? And they're turning to like the Bloom Energy because they're looking for alternative sources. Musk is considering the power generation. But my other two things I remembered is I used to have an old friend of mine, George Ferris, great technical analyst. He actually introduced me to Connie Brown in Chicago. But his quote that I always stuck with me is he always used to say, Travis, you have to out anticipate the anticipators, right? So you have to be successful in the markets, you have to out anticipate the anticipators. So you got to be ahead of the anticipators, right? A step or two. So that goes back to your point, right? Of
Yeah, the
people,
markets are anticipatory.
yeah, they're anticipatory and they are anticipating this. And you can see that because Aaron Turbo had said in that comment thread, he said, I've noticed something this year. He said, I've noticed Intero and EQT Corp and Expand. He said, normally they're seasonally weak right now, but they haven't been, right? Intero's been, they've been
Oh,
kind of
it's kept its near to 40 price.
right. And so why is that? Well, you haven't really got there's been inklings of this institutional wave or retail wave of momentum money in that power generation, but it hasn't really arrived yet. But maybe the anticipators that are anticipating that, they're trying to be ahead. They're out anticipating the anticipators. They're getting in front right now. So you're not getting the seasonal price weakness. So that might be the case of what's going on.
I mean, it totally makes sense. And I mean, to me, it totally makes the, 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 the big simple picture is demand for natural gas, best I can tell, is going to be outstripping supply. And when I tried to work this out in some detail with Gemini, maybe about a month ago, and in the course of that exercise, um, I concluded that by the end of next June, there's going to be a clear cut, break with the past where uh, weak prices for natural gas have prevailed for a very long time. And we're going to break with that because it's going to become, you know, crystal clear that demand is exceeding supply. Um, and we were chatting, I think, a little before this Zoom meeting. Um, and supply is actually not leaping ahead at this point. It's 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 kind of subdued, relatively speaking. I mean, I think this year versus last year, it's up about 5 BCF a day. Um, last I looked, and I don't know exactly when, but I thought it was around 108 BCF a day or 110 or something in that general neighborhood. I mean, when I first came to the Contrarian 6 years ago, I mean, we were pretty distant from these kinds of numbers. Uh, so it's really grown. And so I was kind of thinking, oh, this may be the new normal, you know? Every year we're going to get another 5 BCF. Jesus Christ, we're never going to get ahead. No matter how much demand we is created, the guys in the Permian are gonna basically get so much associated natural gas that there's no way we're ever gonna get ahead of it. As this was starting to be my worry. I don't really have that worry at the moment.
Yeah, it's funny. And again, hearkening back to your big picture room, when you think of the big picture, the age of shale really started to accelerate around 2010. And if you go back to that point, the biggest natural gas basin in the U.S. still is the Marcellus, the Appalachia, although the Permian is rapidly catching up. But those two were basically non-existent in production, right? And today they're over 50% of U.S. supply. So you had these enormous,
16 years.
yeah, you had these enormous fields that weren't, really producing hardly anything that are now 50% of supply roughly that had to be absorbed into the marketplace. And that's kind of been the case. And now, as Gringo has said, Gabriel in our group, he's kind of, he tracks this stuff really closely too. And he's kind of along the lines with you, with the LNG build out the data centers. He says, 27, 28 is kind of the inflection point. And as you said, that's not that far away anymore. We're already in.
It's not far away at all. If it's really true that I'll just say if it's June, end of June 27, when there's like a clear cut, decisive. Actually, when I did this with Gemini, the calculation was, I think, 1.8 BCF demand greater than supply. I mean, clear cut, no doubts, and not ambiguous. But you're going to have visibility to this in the prior quarter. And in the prior quarter, we're talking about, starting around April 1st. So starting around April 1st, work that work backwards. So what? March, February, January, December. I mean, once we're through November of this year, the the anticipators who are trying to be ahead, they gotta be seeing this.
And you have
And
the
they might be
water.
seeing it now.
I think they
I'm
are.
seeing it now, and I'm not a pro.
Exactly. And then you see it in the Permian prices or the natural gas prices out of the Permian, they're now positive because some takeaway capacity has come online, right? So there's some, very positive underlying factors. And then, like you said, you're not a pro. The pros have to be looking at it and modeling, and that's probably why you're getting the seasonal price strength in the producers. And they're piece by piece, they're actually building out supply demand in basin, right? Because they're supplying some of the data centers directly. The data centers themselves, the people who are putting those together, they see that, hey, why don't we build in the Permian, which has attracted a lot of data centers, or right in the core Marcellus, and then they can get natural gas directly from some of the natural gas companies, including they're doing that in the Marcellus with EQT and Antero, and then expand as well.
So
So,
I mean, with all this said, come back to the starting proposition here. Natural gas could lead the energy complex. I mean, supposing for a moment that there's a big coming secular bull market. Just suppose that. And you say, well, which group of energy, what type of energy goes first when it comes to energy? Uh, I mean, I think the case for gas is pretty darn strong. The the only reason that I think the case for oil might be maybe not as strong as natural gas, but pretty darn strong, is because of the circumstances created by the U.S.-Iran war. We start off 26. And incidentally, I have to say, as much of an amateur as I am with natural gas, I'm more of an amateur when it comes to oil. And the only reason I know anything about it at all is I realized in about the middle of April, I didn't have any investment. I wasn't invested in any oil companies, and I had no exposure to it. And I'd been subscribing to Hafer and sort of observing what he was up to and talking about all these imminent shortages. And I said, I better get off the duff here and do something. And I'm not an options guy. I mean, at heart, I guess I'm almost a dividend guy. And I kind of like a safe investment. And so I poked around using Grok at the time, and Grok was basically making suggestions about uh, Canadian natural resource as a really solid investment option. And the more I looked at it, the more I liked it. And so I decided to go in for me big in CNQ. Uh, and once I'm in big for CNQ, then it's I start watching the tape and oil bounce around all over the place, and me getting nervous that maybe I've made a mistake. But I knew when I bought it that I couldn't lose in a sense. In other words, the thesis for me was not just oil will spike and I'll do really well once it spikes. That was not the entire thesis. The entire thesis was an oil spike would benefit my investment, but absent any oil spike, CNQ is a great company in the first place. I mean, it's got a history of 26 consecutive years of dividend increases. I mean, so it's a dividend aristocrat essentially. That's a monumental accomplishment, and their business model is first rate. I mean, they're basically getting oil out of natural sands. They don't have to drill wells. When you drill a well, the well exhausts itself. It depletes. Natural sands, it's more like mining. You,
right. Yeah.
you dig a big hole in the ground, you get in there and you get some oil, and you can just keep getting it and getting it and getting it by getting more the sands out, evidently. and you're not really depleting a well. You're not depleting the supply of oil in your natural sand mine. It just continues and continues for the 20 plus year, range.
Yeah, there's this Edward Chancellor. He's written a couple really good books. One's The Capital Cycle, which is a foundational book for investors that you should read. Um, and he's got another one like the Price of Time or something like that. But when the Capital Cycle came out, and um, I wrote two articles in the Contrarian that were one or have been historically two more of the well-read articles. But it was interview of Edward Chancellor, part one and part two, and I think I authored those in 2015, 2016. But I remember the reason I bring it up is, people asked him in this interview process about uh, what he liked as long-term investments, and he mentioned the Canadian oil sands, and he mentioned Suncor, which is a big one, and then Canadian Natural Resources, just for the reasons that you mentioned, in that they're long-lived oil assets, right? And that's
And very cheap costs of production on top
right.
of it.
Well, and where a lot of people got into trouble here on the long oil side, as you mentioned, was with options, right? Because they were shorter term options, and it, and we were talking about this, and I actually wrote a piece because on interest rates, and there's this analyst I really like that posts on X, and his name's JH, but he said everybody, kind of what I paraphrase what I've been saying in my interest rate articles. We say everybody's making fun of Bessent, like how can they influence interest rates? But he said the same guys that are making fun of them are the guys that have been run over in the oil market, right? Because the administration, Bessent, whatever they've done, they've you know basically trampled the short-term speculators in those options in the oil market. Exactly how they've done it, that's a topic that we could probably spend another hour on. But and the JH's point was, hey, look, everybody's making fun of Bessent with interest rates, but you don't want to be on the other side of what they're trying to do, which is
No,
to have lower rates, right? So, eventually the market fundamentals can reassert themselves, but that can take a long time. And so we've seen it with oil. But yeah, so the Edward Chancellor was in agreement, that these are long-lived assets, and that's as we've been talking, I've seen that it's worked for you, whereas a lot of people who were in those, April, May, June, July options were wiped out on the long side. But Canadian Natural Resources, I believe you're up in it, if I'm
I'm
not
up.
mistaken.
I'm up maybe just off the top of my head, 12%.
Yeah, not bad for, you know,
For a really volatile part of the marketplace, to put it
right.
mildly,
Yeah.
where people are getting run over. I feel like I made a sound decision. And I just happened to bump into an article today. It was comparing Enbridge and CNQ. And it happened that the writer actually was recommending CNQ. He was saying, listen, they just had like one of their most outstanding quarters ever in Q2. I mean, the Iran war has pushed the oil price through the roof, relatively speaking. Well, we started the year at 60-ish or something. And I mean, today, West Texas is what, 81 or thereabouts. Another $20. Uh, CNQ's got an investor presentation, and it basically says every time WTI oil goes up $20, the company makes 91% extra profits, actually free cash flow, 91% extra free cash flow. So I mean that's so they're basically almost doubling their free cash flow because of the increase in the oil price. And so the company itself is essentially going gangbusters, even though the oil market is a gigantic roller coaster ride.
Well, and that's a perfect transition because the same thing, the natural gas producers that we've owned Antero for a long time, a lot of people have done really well. EQT, Expand, they're enormous. In fact, EQT and Expand are basically, they produce as much natural gas in the US as Exxon and Chevron, produce globally. So it's in the US. And what we've talked about is, you know, the 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 bear market in natural gas has lasted a long time. And over that secular bear market, the prices have averaged about $4, right? So if we go into a bull market, you would think it'd be higher than that. And the companies will be just like Canadian Natural Resources on the oil side. If you even have $4 gas or $5 gas, the profitability and free cash flow generation is going to be enormous. It doesn't take that much.
Yeah, I
Uh,
mean, there's no extra costs.
right.
I mean,
Yeah.
it's just suddenly the money is flowing into the bank account directly.
Yeah. Right. And they've optimized. I always say with Antero, when I was studying them back in 2015, they spent about $3 billion in CapEx from 2010 to 2020, call it, just on average, building it out. They IPO'd, and ironically, the IPO was, basically their high price, right
Right.
around then.
Right. It was like
And
60 something.
yeah, and but they now, the CapEx to maintain a much bigger production base is less than $1 billion a year. So they become much more efficient and there's increased volumes. The production size and scale is bigger. All of them, all the big ones, Expand, EQT, Antero have consolidated. They bought other producers. They bought pipeline assets. So they have enormous leverage, to an increase in natural gas prices. And if, say Europe's 20 now in terms of the British thermal unit price, and the US is, closer to 3, there's going to be a middle ground somewhere. Maybe it's, 6 or 7 that it ends up averaging out and you make enormous money. But just thinking big picture wise again, the, prior to the shale
Oh, and
revolution,
and and just to add a quick point,
yeah, go
the
ahead.
wait won't be terribly long this time. In other words, for me, after joining the Contrarian, I had like a magical year and a half, from July 2020 to like mid-April of 2022, a year and 3 quarters. I was up like 6x at my peak. But a lot of the time since April of 22 for me, and with companies like AR and BTU, has been a lot of sideways activity or chop. There hasn't been any real sustained gains. There's been a few peaks of the 45-ish range, but they don't sustain and they don't grow. But I think now things are about to shift. We're,
Well,
we're
and
gonna we're gonna start to grow because demand, the sources of demand that we're talking about with LNG and the data centers, they're growing and they're growing, hugely.
and then, big picture, the starting valuation is not bad because even Antero today is 10, 11, 12% free cash flow yield right now. And, obviously that can expand if prices of natural gas and natural gas liquids and oil go up. But, I was thinking again, bigger picture, prior to shale in 2010, and I've used these lines a couple of times, so if you've heard them as a listener, just cement them into your brain, or you might say, I've heard this before, but prior to 2010, natural gas prices averaged a range of 10 to 1 to 6 to 1 of oil prices. So if WTI is 80 now, if you go 10 to 1, that's $8 Henry Hub
Or
price.
12.
Yeah, or if you go 6 to 1, there you go, 12. And it makes sense too because the energy equivalent, basically natural gas it's 6 to 1 to oil, right? And so again, it fits that ratio of 10 to 1, 6 to 1. So and because it's so much cheaper, natural gas at $3 or even 3.50 or 4 in the basins themselves. If you go to the Permian Basin or you go to enter any of the energy basins, when they're generating electricity or using energy, they always use natural gas, right? Because it's a lot cheaper than diesel. It's a lot cheaper than natural gasoline or things like that. So, um, and then last, just while I'm on it, like I mean, Henry Hub got to $10 in 2022, right? So that wasn't that long ago. We've settled back in, but there's kind of complacency, but there's the kindling is kind of set for there could be a fire, with natural gas prices. So,
Right, and as you're saying, it's actually likely to be the first fire, but this then brings us back to, well, what about oil?
yeah.
I mean, uranium we could put aside because it's a longer development. Uh, and solar and wind, you've got the problem. it's the problem of intermittency, that you need battery storage to be really reliant on that, and battery storage alone may not cut it. It may be too risky. So of the non-risky fuels and energy sources, um, you know, uranium, but that's longer haul because of regulations and new technologies that need to come into being,
and just the time to build,
SMRs.
yeah, time to build the nuclear reactors.
Yeah, but even if the SMR guys end up doing what they claim they're gonna do, I mean, where they basically turn themselves into factories and they can crank these things out, I mean, rapidly, measured in months, not years, not decades, and not multiple years, but multiple months. This is what the future looks like it could be. But in the immediate term of the next 3 to 5 years, I mean, oil and natural gas seem to be the key energy sources, and for the data centers, it's natural gas. So but
and and
now,
and you and you know coal's in there too. People forget though, but
yeah,
yeah,
coal
coal.
coal is certainly in there, and yes, in places where the politics allow it to more
Yeah.
easily be in there.
Well, and I mentioned it somewhere in the chat comments, but China's got 3,200 operating coal, power generation facilities, and they're in the process of building 800 more, right? And so if you look at electricity generation around the world, it's still coal is the biggest source of electricity generation, believe it or not, right? But now and
And You,
other
you
stuff,
you published a chart recently showing that.
yeah. So
Yeah.
it's but like you said, the two that because coal is ostracized in the West still, to an extent. It's natural gas is taking the lion's share of capital for baseload power generation, and then oil is kind of behind that. But yeah, coal is still important too. But as you're alluding to, the money's going into the natural gas and diesel to a lesser extent.
But I do believe that the U.S.-Iran war may have set up oil for a much longer term, better performance than certainly than the market is pricing right now, and maybe even than most investors are thinking is feasible. But I mean, I read different numbers of how much oil production has been foregone due to the war, but I never read a number lower than 500 million, and I read 1 billion frequently, and even more than 1 billion. And so these are amounts that we could have had, should have had, and don't have. Um, they're missing barrels, in effect. Now, we had a surplus going into this year of about 2 million barrels a day. Um, so, I mean, you could say billion gone, the surplus gone, but then some, gone, but then some, because 2 million a day, this is 700 plus million a year. We got 1 billion, arguably, or more, arguably. Um, so you've got this factor operating, which is the surplus is gone. But it's worse because facilities have been destroyed. And the shut-ins we don't know yet, but the shut-ins may have harmed production. Restarting an oil well is not like flipping a light switch. The light switch comes, you flip the light switch and the electricity comes on, and the house has bright light. You turn on the oil well, and some percent of the time, and it's not clear to me what percent, the oil doesn't flow anymore. And then what? And if that percent is a big number, like let's say 10%, it's a big number. out of 20 million a day of production in the Mideast, that's 2 million barrels a day. That's the surplus we came into the year with, which we just eliminated due to the shut-ins, but we might eliminate it again due to restarting of the wells, and this is not the only issue, because you've got on top of all this a newfound appreciation for oil energy security. You know, the US has depleted its SPR below 300 million barrels. We're down to about 290. Um, I interacted quite a lot with Gemini trying to estimate the risk levels to our SPR at various storage levels. And between 350 and 300, Gemini codes it a green, no risk. Below 300, yellow. Starting at 265, orange. 250, red. Serious threat to the structural integrity of the salt caverns. They could collapse, and imagine what happens to the price of oil if one or more of our salt caverns collapses. You know, the Trump administration, to the best I can tell, is trying desperately and consistently to keep the oil price under control. And they're doing so in part by trying to make up some of the lost production and supply, due to the shut-ins, lost production, and also the lack of transportation through Hormuz and the Red Sea, and maybe more. Um, so I'm losing the train of my thought. I'm
No,
sorry.
no, I'll jump in for a second. I always, personally, I'm more bullish on natural gas because I think you have some of those same drivers, Qatar facility being down. But the thing I come back to with oil, and it's another thing
The
that
SPRs I was on. Yeah. Okay.
yeah, we'll come right back to that. I come back over and over with oil, but oil, it averaged, $100 WTIC, which is West Texas Intermediate crude from 2008 to 2014. If you just use CPI inflation, it's 150, $160 a barrel today. So even at 81, oil is really cheap, right? And I make that point with the CPI and interest rate calculations. I said, even if oil doubles, energy is only 6.3% of the CPI, and really half of that is tied to residential electricity prices. So it's not going to have that big of cost increase or component increase. Now, politically, people are tied to it, especially as you go into the midterm, but oil at 81 is not expensive, right? And it's not a big part of the average household budget, and there's a lot of room for it to go up. In similar fashion, natural gas, at 350 Henry Hub is really cheap, right? It's not. So you have, in the bigger picture perspective, and we don't know, there's always a lot of, technically in charts, and there's all these things that happen. There's a lot of squiggles, and you just don't know, when the takeoff point is, right? For these. But in the bigger picture, they seem very cheap, relative to other asset prices. And then, just that law of supply and demand when, there's an old saying in commodities that low prices cure low prices, right? Because, people keep increasing demand, and you're seeing that with the LNG and with the data centers with natural gas, and then oil in similar fashion. You see it with the petrochemical, the plastics and all the uses that it has. So again, bigger picture, I think that, if you could go to sleep for 5 years, you're probably going to have much higher uh,
Cost
natural
of
gas.
energy.
Yeah, cost of energy across the board,
Absolutely.
across the board.
Absolutely. Across the board.
And that's what, Musk sees. That's why he's building the six times the annual, you or six times he's building the solar facility that is six times the biggest capacity for solar. And actually, the facility he's building at Tesla is bigger than the annual solar generation of all of the US right now, right? So he sees this power generation is going to be the key stumbling block. And that just seems bullish, incredibly bullish, that isn't really priced in yet. And I always said 2020, 21, 22 is the appetizer. and I said that the main course would come. Now I didn't know that we were going to have so many years. It's like you're at dinner
Well,
and
yeah, but you know that's right. The thing is that after the appetizer, I mean, it's like the kitchen went on strike for and walked out,
yeah,
you
and
know, in the middle of the meal.
a lot of people waiting at the table said, "Hey, I don't think the main course is coming." Right? So they walked out, you know.
Well, that's right. That's right. It takes a lot of patience and actually a lot of stamina to
Right,
last 3, 4 years in the
right.
doldrums. You you speak about conviction being earned. I mean, this is certainly the period where you're going to learn to abandon the trade or to have conviction in the trade.
Well, and I think that we'll close, and you and I'll continue talking after, but we'll close this recording on this note. I always think of you as stoicism because of the meditation you do, and I use quotes time to time in my articles, at the beginning of my articles, and you probably know this name, how to pronounce it better, but Epictetus, is that how you say it?
Epictetus. Epictetus?
Epictetus. Yeah, he was a former Roman slave, right?
Stoic philosopher.
Stoic philosopher, but that it was born out of being a slave and then, coming out of that. And so I've used one of my quotes in that last article I wrote on interest rates. But anytime I see stoicism, I think of you that way. So and it
Well,
goes
nowadays it's probably true.
but like you said, you need an extreme amount of patience. And one way to do that is, as you mentioned, with CNQ or how we've held Antero or expand or EQT to Equitrans too. It's just a long process. So you have to have patience and you know, uh, thanks for everybody who's listened. Dave and I really appreciate it. And if you guys have any thoughts, just chime in. But David, you got anything to say before we end the recording?
Hope you guys enjoyed the talk.
Yeah.
To be
I love,
continued.
yeah, to be continued. That's the great way to end it. Take care, David.
Okay.